And well, I guess one thing that another problem we have is well, finance. So we will try not to make it too boring. We'll try to liven things up a little bit with some interactive activities and try to, move through it in a way that's kind of happy and satisfying without getting too boring. So just before I get going, I think someone is going to be sharing in the chat a link to a spreadsheet that we're going to be using a little bit later on. So if you haven't already, try to find that in the chat and download that. I'll remind again shortly once we're ready to jump into that activity. Okay, moving on. Well, finance it's really a language that tells a story. And like I said before, it's really something that we feel everybody should have a basic understanding of. So we're going to kind of jump into that tonight. When we normally think of finance, especially for those who are not in a financial role, most people tend to think of statutory accounts, balance sheet, income statement, cash flow statement, that kind of thing. But in reality, that's really just a small part of the story. And one sort of negative attribute of that sort of thinking is that those statements are really just static information. In fact, they're, for practical purposes, they're all sort of backward looking. They reflect on the past, and to use them normally, it's sort of like driving your car, looking through the, oops, what have I done here? Driving through the rear view mirror. So you're kind of looking at what's behind you. So that doesn't necessarily help you drive your car or your business. Also, they can sort of mask the real truth. For example, consider two different businesses. One with $5 million in revenue could be, selling 1 million items for $5 a piece, or a same company or a different company, sorry, with the same revenue, same 5 million in revenue, could sell 5 very expensive $1 million machines. So the statements would look very similar, but the structure of the two companies are vastly different, and the way you approach them is vastly different. So really, like a lot of things in life, the devil's in the details. So we're going to help you drill a little bit into some of the details in sort of a light way to just help you understand a little bit more about what we do in the finance world. So I encourage you to embrace the challenge, and I guess you get out what you put into it. So question for everyone. Can anyone tell me what you think is the most important thing needed to grow a business? And this is particularly true for smaller SMEs and startups, but really for all companies. What is the main lifeblood of all businesses? Anybody got an idea they want to share?
Coming in on chat, Tim, everyone's saying cash, gross margin.
Exactly. So I'm impressed. Cash it is. Yeah. So yeah, cash affords you a lot of comfort, security. You can pay your bills, make your payroll. You can invest in your company to grow it. And if you're doing really well, you can pay some back to your shareholders. So yeah, we're going to focus tonight on how do you read and use financial statements in order to drive cash? And what actions can you take? And how do you measure and monitor the success of those actions? So how are we going to do it? Well, let's think of it, since it's sort of dinner time now, we'll think of it as a dinner. I'm going to kick off with the appetizer. I'm going to give you some information about financial statements, and we'll talk a little bit about ratios, some of the levers you can pull to get more out of your financial statements, and some KPIs and things you can do to help evaluate your business. And I'll be sharing a little bit later on the 7 key levers that we think are important that we can manipulate with our financial numbers to get a better sense of how the business is going and how to grow it better. And then, sorry, I'm just going to back up here. My slides are a little bit out of order. So that's me. And then I'm going to hand over to Fraser, who's going to pop along to talk a little bit about sales. And he's going to really, think about revenue forgives all sins, right? And nobody ever saved their way to success. So really the way to success is growing revenues, and that involves the sales process. So Fraser's gonna dive into the sales process a bit. It might require a bit of heavy chewing because some of it can be a little bit heavy, but I think the way Fraser does it, it really highlights the components of the sales process and how integral each is in the whole sales process end to end, and how changing one part of the sales process can really have a big impact. And then my colleague Jeremy is going to join us for dessert, and he is going to sort of tie everything together. And, really there's no point in selling more of a product or service that's losing money, right? So he's going to try to tie together profitability in the sales process and the cash generation that we see coming out of that. So that's what's in store for you all tonight. So let's jump in. So we get back on my track. We're going to jump into some ratios. Now, I'm not going to go into detail on these. Some of them can be fairly complicated, but I think the important point to note with financial ratios is that all of the underlying information comes out of your financial statements. When used appropriately, they can tell you a fair amount about how your business is going. You can see, in terms of the profitability of the company, there's a few ratios that can tell you that. Your debt levels, your liquidity, how quickly you can pay your debts, how efficient you are, especially if you're like in a manufacturing business with your stock turnover and your inventories and that kind of thing. And also there are ratios that investors will rely on to get a valuation of the company, such as your price earnings ratio, which is really more as you get into larger companies, listed companies that will have publicly traded shares. But all these things to certain degrees can be applicable to even smaller companies. Okay, so where are we? Right, so let's jump into an exercise, I think is the next best thing we want to do. So just a reminder again that in the chat, there was a link to an Excel, I think it's an Excel or a Google Sheets file, that it's a P&L and a balance sheet for a hypothetical plumbing company.
It's a screenshot of the plumbing company, yes, a screenshot.
Yeah, okay, so we've got 4 accounting periods here. And I think what we want to do is we're going to break out into Fraser, 5 or 6 breakout rooms. And I'm going to challenge you to, within your group, have a look at these numbers and sort of comb through them and tell us what you think. You'll maybe nominate someone within the group to be a scribe, to take notes. And once you've put your head together and talked about what you think you're seeing. Is there something that concerns you? Does it look good? Does it look bad? Do you have any questions about, the way the numbers are flowing? What sticks out for you? These kind of things. Just imagine that this is your company and you're looking at these numbers and you want to know how well you're doing. If we look at the top section, the retained profit, we seem to be, growing, making money. Okay, but is that the real story? So have a look at it, and we'll spend maybe about 10 minutes or so in a breakout room where you can have a look at this. I think within the breakout room, if it's possible to get one of the members of the room to, Fraser, I think you can share a screen and share the file within the group, if I'm not mistaken, right?
Yeah, you can do that, no problem.
Okay, so if one of the members of the group wants to share their screen and put the file up on that so we can all talk about it together. And one other person maybe take some notes, and then we'll come back together in about 10 minutes and we will kind of go around to the different rooms and talk about what you've seen and questions you have and observations you've made. Mm-hmm. Does that sound good?
Yeah, and Tim and Jeremy are going to jump between rooms, so they're going to give you some insights, they're going to give you some ideas, things to think about. So you've got 10 to 15 minutes. It's not the easiest thing. Can everybody download this screenshot? Has everybody got that? The one that's in the chat? Yeah, got it, the email as well. Yeah, but we'll use the email. We're going to use the Google document in the next interlude. Yeah. So the screenshot's the one you need now with the profit and loss statement there. Yeah. Perfect. Right, I'm going to open the rooms. If you can all jump into them, and then you can nominate someone to do a screen share. So someone needs to pull up the document, and then 2 or 3 of you take notes. And then when you come back in, you're going to raise your points with the group, and Tim's going to run through them with you.
Yep.
Okay, I think we're good. Tom, are you okay? Nathan, are you all right?
Yeah, I'm good.
Yeah, perfect. Okay, super.
Yeah.
You should have received it.
Oh,
Perfect.
there he
you go.
goes.
Yeah. Nathan, you good?
Yeah, I'm good.
Sorry, have you got an invite to a room?
Yes, I did.
Yeah.
Do you
okay.
need me there?
No, don't need you there. If you've got stuff,
Okay.
that's fine. Yeah, right. No problem.
No, I'm just admitting people whoever's coming in last minute.
All right. Sorry, you're yeah. Sorry, Nathan. Yeah. So, yeah. Actually, no, ignore me. I thought you. I didn't know. Yeah. Sorry, Nathan.
No worries, no worries.
Excellent. Right. All good.
Yep.
One of the participants, Mijel, she's actually the person who is leading the entire cohort. So I think they're doing a case study within the entire group. So she asked if she could jump around. If that's
Yeah,
okay,
perfect.
I'll make her a co-host. I
yeah.
think she's just going to check in and make sure everybody's actually participating. She's going to be the school
Fantastic.
teacher in that sense. So
That's great.
yeah.
Who's that?
Mijel, Mygel. I didn't get the chance to upgrade her.
Just
so-
update her. That's fine. Yeah, that's great. Perfect. Yeah, the more the merrier. Yeah, that's really good. Yeah, so.
Let's see if I can find her. Mijel.
I'm just trying to find her. I go into her group. Yeah, so. Jeremy,
Went into 4, going to go into another one now. Okay. I've lost the breakout rooms though.
yeah, you need to
More.
just jump from breakout room to breakout room. Yeah, so.
Okay, well, let's breakout.
I'll
rooms.
just
It's here.
assign you.
No, it's here. It's okay. I've
You
got it. I've got
Yeah.
it.
Where did Mijel go?
I'll go to 5 next.
Not in yet.
I can't see her. Yeah.
Yeah, hopefully she didn't get bumped off. It tends to happen. Let me see.
But I should be okay. I've not.
Yeah,
Zoom's
yeah.
pretty good. It depends if they get disconnected.
Yeah.
Okay, Tim, all good?
Okay, we're
Yep.
back. Let me-
Excellent. Did you get around all the groups?
Yes, I got to quite a few. I ran into Jeremy at one point, so I backed out.
Funny, yeah? You got 20 seconds left.
Okay. Okay, do we have everyone back? Okay. Right, I think everyone is back now, so we will kick off. So let's have a little discussion about what we've found. I bounced through quite a few of the rooms and heard some really good discussions going on. I think quite a few of the groups honed in on what some of the big problems are with this company. So that was good to hear. So why don't we just go around the rooms here. I'll start off in numerical order, go room number one. Someone from room number one want to just talk a little bit about what you found and any questions that you had? Room number one.
Yeah, Tim, I guess it's from our perspective, it's a rapidly growing business, but it's also utilising a lot of equity and liabilities to bank loans, etc. So it's the total liabilities are really running pretty high as it goes from period to period, and it's really a business that's pretty cash strapped.
Be able to take up COVID vaccine.
Yep, good observations, right? Anyone else from room number one have anything to add? Okay, we'll move to room number two. Do you want to add anything to that, or maybe you saw something different? Hello, room two.
Don't be shy. This is a great chance to engage. Please do feel free to let the questions flow.
Yeah, okay, well, should we move on to room three? Anybody from room three see anything interesting here?
Maybe just a quick one. I think what the group discussed, they will realize that they're sitting on no cash at this point of time. Liquidity is very low. Basically, they are living hand to mouth at this point of time in the business. They invested whatever they earn back into working capital or fixed asset. So basically, they have very little liquidity at this point of time. Margins have also not really gone up. Despite growing very fast, their net margins are about 5% over this period. They are not able to earn more despite expanding. So that's a few observations. Yeah.
Right, exactly. Yeah, so we've got a company here that on the surface looks like it's doing quite well, but as you dig down into it a bit, you see that really it has no cash flow and it's living off of borrowed money, basically, and paying a lot of interest in the process, which is hurting its overall financial performance. So room four, anything beyond that you noticed? No. Okay. Well, I think that's really kind of hitting the high points of what's going on here. Is the company is just not really being managed all that well, and it's not using the financial statements to tell the true story that they should be telling. So that's really kind of where we were headed for with this exercise. Okay, so in the interest of time, we'll move forward onto the next item. Before I do that, one of my colleagues shared a story with me that really kind of helps illustrate the next point we want to move on to, and that's it's really about the British cycling team that didn't do very well for a very long time. In fact, up until, in the 100 years or so leading up until about 2003, they had never won any Olympic medals, hadn't won any Tour de France events. So in order to try to change that, the team hired a guy named Dave Brailsford in 2003, and they hired him because of a strategy that he had called the aggregation of marginal gains. And what that really means is breaking down everything that you can imagine that goes into riding a bicycle, in a racing sense, and just trying to improve all those little things by a very small margin, maybe 1% or so. So they went through hundreds of little things that are involved in not just the bike itself, but the team traveling. They took their own pillows so they could sleep better. They painted the inside of the team trucks bright white so they could spot any dust or dirt that could be getting into the high performance gears and parts of the bike. Just little things like that. And after some time, they realized that they were making significant gains. And by the time the 2008 Olympics rolled around, the British team won 60% of the gold medals. And 4 years later at the next games, they set 9 Olympic records and 7 world records. And in that same year, Bradley Wiggins became the first British cyclist to win the Tour de France. And the following year, his teammate Chris Froome won the Tour de France and went on to win it in the next 3 years as well. So that's a little story to illustrate how fixing a lot of little small things can lead up to some fairly significant gains. And that's really the philosophy we want to impart, in terms of finance. Finance isn't normally big fixes. It's going through the detail and making lots of little changes that, when all added together, can have a big impact on the business. Another good example of this is in Japan. The auto industry is very well known for their use of kani, constant and never-ending improvement. So it's really, if you think in terms of compound interest, it's sort of like compound improvements. And it sort of works the same way. When you pile a lot of little tiny improvements on top of each other, you can end up with some fairly significant gains. So that's, one of the things we in the finance world try to do with all the companies that we work with, is to look for those little gains. Flip over a lot of rocks to try to see where very small changes can be made to help improve the company. Right. So I mentioned earlier on that we also wanted to talk about some levers, and these are, we call them levers because they're little things you can pull to make little changes in the way the company is being run. So here's a base case that I've put up on the screen. So we've got a company here. Cash flow is terrible. They're they're 3 million or so negative, meaning cash is flowing out a lot faster than it's flowing in. They're turning an operating profit, which is good, obviously, but the cash flow situation probably needs to be addressed. So what we've done here is highlight 7 what we call levers that we can sort of play around with to make adjustments to the whole process of the company to hopefully see some improvements in the situation. So we've highlighted a few here. We can increase the price, that'll bring in more cash. We can increase the volume that we sell, bringing in more cash. We can try to reduce the cost of producing our goods or service. We can try to reduce our overhead costs. We can play around with the number of days. We can ask for our clients to pay us faster. We can try to hold less inventory, only bring in the inventory at the last minute when we need it. Or we can speak to our suppliers and ask if we can maybe pay a bit more slowly. All of these things on their own or together can help to increase our cash position. So if we flip to the next one, going back to thinking about very small gains, we call this the power of one. So if we put just a 1% or 1 day increase on each of these levers, you see that we do, in fact, improve our cash flow situation quite substantially. We add about $1 million. I mean, it still doesn't take us into positive territory, but it does have a fairly significant impact. And you can see the 3 highlighted items are, really where the major part of the impact is coming from, and that's increasing our price that we're charging, cutting the cost of production, and collecting from our clients on a much more timely basis. So those things can help us. So if we want to play around with this further and try to get ourselves into a cash flow positive situation, we can start moving these numbers around a little bit more. So here's one hypothetical situation where we've managed to do just that. So we've got ourselves at the end of the day here to a positive net cash flow situation, and we've enhanced our operating profit quite significantly. The only problem with this is it might work for this company, but for your company or another company, it might not work at all. If you're operating in a very competitive environment, a 5% increase in your price might kill you, right? So each of these things has to be taken with consideration towards the company that we're talking about here. Is that actually possible? You wouldn't just blindly go do a 5% price increase without first assessing the potential impact of that beyond the simple cash flow scenario that we're painting here. So you want to make sure that that's not going to adversely impact your company. But it's just one illustration of how making small changes to different parts of the company can have a big impact on the company's financial situation. Right. So I think that's about it for me. Try to wrap up this bit. Does anyone have any questions? We can open it for Q&A. Jeremy, do we have any questions in the chat?
Yeah, there is one in the chat, and it's this, Tim. Considering highly competitive market, if we can't increase price and can't increase volume, what can be the best alternative solution?
Right. Well, okay, that's a bit of obviously a challenging question to address. So it really depends on the company. We need to look at each of these things, or potentially something beyond these, these different levers that we've illustrated here. To
Tim,
what works for that company.
Yeah. Yep. Tim, if I could make a comment. Sure. So you're fixed in terms of your sales. You can't increase your sales, or at least you can't increase your price. You can't improve your gross margin because it's highly competitive. A couple of things you could look at. First of all, you can look more at the balance sheet, which is some of the levers that Tim's talked about here. If you can improve your cash flow by reducing your inventories, for instance, more efficient inventory management will help your cash flow. As Tim said, if you can maybe talk to your suppliers about, hey, can I have extended terms? I'm on 45-day terms now, can I have 65-day terms? So that's another way that you can start improving your cash. Not really here, but what I have found in many businesses that I've worked in is when you have a range of products, you have some customers which are much less profitable than others, or products that are not profitable. So you may want to look at your customer segmentation. There may be customers that you don't want to deal with because you don't make enough money with them, and by losing those customers, although you may decrease the total revenue of your business, you might either improve your profitability, and you're certainly going to you might improve your cash flow. So look at your products, look at your customer segmentation, pull levers on the balance sheet, and they're the sort of things that you might be able to do if you can't move price and you can't get lower raw material costs. And that would be one of the other things you may want to look at, is talking to your suppliers and seeing if you get lower raw material costs. So they're just some things you might be able to do if you can't move price or volume.
Right. And I guess as a segue into Fraser's bit next, we could look at our sales process and how we're handling the whole sales process. So, right. Any other questions? Anything else in the chat?
No, nothing come through in the chat. Yeah.
Okay, I'm going to stop the share. Okay. Right. Well, thank you, everyone. I appreciate your time. I will hand it over to Fraser now, who, I don't know, do we want to have a quick break or anything, or do you want to jump right in, Fraser?
does everybody want to take a quick 5 minutes or we get on with it? Thumbs up if we get going. Or keep going in the chat. Thumbs up. Excellent. Okay, that's the vote. Done. Majority has spoken. We'll get going. Yeah. Right. Okay. Thanks, Tim, for that. I really appreciate a nice little segue in there. That was perfect. So, so let me introduce myself. My name is Fraser Morrison. I'm the CEO and founder of 1000 Steps, which is a sales consultancy business. And we build corporate sales models for companies. We look at how they sell, how they drive into the marketplace, and how they grow their business. And you might think, well, what's the correlation with a balance sheet and a sales consultant? There's a very, very deep correlation because in the world as we know it, most companies that I work with or come across don't understand their metrics and don't have clear and forecastable data. I have one client, though. Well, I mean, it was quite interesting. I had I'll tell a little story. I was having dinner with the chairman of Volkswagen Audi Group. And he said, if I had a 50% accuracy in my CRM, I would be happy. So the dysfunctionality within CRM and data within sales is pretty staggering. I also, one of my clients made a 1% shift. So they changed one thing in their business and grew the business from 2.5 billion a year to 7 billion a year and turnover over 4 years. So you would be surprised at the impact of the detail and the little things. I don't believe that the sales world is geared around finding those things out. I think you need a numbers-based person, a quantitative person, a CFO, that they're the ones that can understand the numbers and interpret in the right way. So today what I'm going to do is I'm going to share sales modeling with you. Let me just do a screen share here. We're going to look at pipeline analysis, CRM. And again, you're on a learning curve here to learn how businesses run. Most of you are in one company. The idea here is that you get different insights over the year from different people, different businesses, and how these things come together to help you become more competent managers. My belief is that the world of sales isn't run and delivered by salespeople alone anymore. Every single person in the organization has a responsibility for sales, should understand sales. And as I go through this with you, you'll start to see probably the rationale of why people don't understand it and it doesn't get managed as effectively as it should. If you've got any questions, just ask it in the chat. I'm going to spend about 15 minutes going through this with you, and then we're going to jump in a breakout room. We're going to go through an exercise. Annika's going to share a document with you just now. And then you're going to work through this document, and we're going to do a reverse analysis of on a Google Sheet, strategizing around activity to hit sales targets. Yeah. So let's talk about CRM. 48% of companies want to improve the sales funnel. 22% of salespeople in the world do not know what CRM is. 40% of salespeople still use spreadsheets. CRM used properly creates a 40% to 42% more accurate pipeline. 47% of companies using CRM well found it had a significant impact on customer retention. Sales reps saw a 26% increase in revenue when they were using the CRM properly, and sales organizations are 81%. Effective sales organizations are 81% more likely to be using CRM well. I do have to say, in my experience, I've worked with a lot of businesses. I don't find any of them using CRM that well that they would say we're 5-star in it. And again, if we just look at a little bit more detail around this, and CRM is at the heart of stats and metrics and how you manage sales teams and sales process. And 79% of data collected by salespeople doesn't go into CRM. Which is staggering. You know? 76% of salespeople are not using all the tools. 47% of management believe CRM in its current form cannot help them achieve quota. 85% do not believe that CRM is easy to use. 26% believe it's difficult to use. And management only spend 13% of the time optimizing their software. So why is it like this? I believe there's a few reasons. Management at all levels don't know how to manage through CRM. They tend to export the information at spreadsheets if they're doing that. It's not user-centric. CRM is built for salespeople, or should be built for salespeople. It's time-consuming. It's a pain to do. Don't want to do it. Implementation is not pedagogically sound. The learning structure behind an implementation is not, usually it's not good. It's tailor-made for leadership, not salespeople, and it's not priority in a business. In most businesses I see, actually, it's not a priority. It's something that sits there. Yeah? And the dashboard and the management, you can do a variety of things with your dashboard. And a good dashboard lets you manage your business far more effectively. And we should have oversight on that. It doesn't matter of your operations, of your back office, of your front office, if you're that understanding of what's going on from a sales perspective within the business is really, really important. I mean, my philosophy is there's no degree in sales. So by default, how do we define what good is? Selling is extraordinarily complicated, and salespeople don't get sales management don't get the credit for the complexity that goes into a sales process. I mean, you've got everything from lead generation, you've got that sales process, the mapping of the sales meetings, and we're going to go into mapping a pipeline. That's the exercise today. But you've got CRM, you've got metrics-based management, you've got admin support, marketing, team members assigned the roles around the process depending on the complexity of it, the constant training and development, and you've got templates, analytics, marketing, content development. So all of these things lead into a very, very complex formula that creates success for businesses. So if we look at a simplified structure in the sales model, you've got your start of the process, inbound lead gen, outbound, you've got account-based marketing, you've got partnerships agents, you've got that qualification piece that sits in the middle, and then we step into the pipeline. Okay, so the management of a pipeline is really what we're going to address today. So I don't think there's many marketing people in the room today. And if we look at the start of the sales process, it starts in a very simple way. It starts with an introductory meeting or a courtesy call. I've worked with everything from startup to billion-dollar sales. They start with a courtesy call. We want to get ahead of the curve. We want to be in there before an RFP gets issued. Okay, that means you've got to be engaging with the customer before. If you step in to a meeting and a sales cycle, it means you're not early. It means you're late. So the only way you can be early is courtesy calls that lead into a qualified opportunity on a sales cycle. In this example here, a semi-complex sales cycle. Yeah. So I'm going to go through 3 sales cycles today with you and just explain the rationale of each of them work to give you a little bit of insight. And it doesn't matter whether your business uses 1, 2, 3, none. That's not the point. The point here is you should understand what these are. Most people don't, and that's why I've got a job. And they're not managed properly, and they should be managed in a quantitative fashion, not go and do it, yeah, right, you know, which is the way most models work. So this model here is a simple inside virtual sales cycle. So virtual means it's in the cloud. It's Zoom meeting based. It's selling a product that usually will cost anything from between $3,000 and $10,000. It's a verification for the client that you're legit and that you know they just want a touch point with one person, and they probably reached out to you strategically and said, I want something. That first part of the sales cycle is an unqualified opportunity. It's a first meeting, and they will answer questions. You will answer questions on it. It might take 30 minutes to an hour, and the client will then ask you for a proposal. You'll send a proposal to them, and the paperwork will get done, the onboarding piece, and off you go. That is all done in the cloud. As you can see, there's gates there, right? They're very clearly delineated. There's certain actions have to happen before it moves forward. A slightly more complex virtual sales process would put a discovery in there and then a proposal, but they're all done in the cloud. What's important here is if it's done properly and accurately, you then end up with a quantitative set of data that allows you strategically to say how many first meetings, what's the quality, how many of these do I need to do on a daily basis as a business to hit our numbers. Yeah. How many proposals do we need to submit? And then obviously the byproduct of that is how many clients come in. Yeah? So that's your first sales process. That's a basic, simple process. Large organizations have these. I like these in large organizations. Does anybody know why they're good? Even in a big organization, yeah, where you're selling $1 million, $10 million, $50 million, $100 million product. Why is a small sale like this good? Put it in the chat.
There is a question in the chat, Fraser.
Right.
And the question is CRM more useful for key accounts rather than fragmented customer base? Insights are a bit more hard to be generated from multiple small clients than big accounts. So
yeah, I've got that. So
yeah.
let me just come back to that in a second because it's a great question. Yeah? So why do we like this process here? It's a very simple sales process within a large business. Exactly right. Yeah. It's spot on, Jason. It's a foot in the door. Yet we put our worst people on them. Yeah, we put the junior people on it. We put the least competent people into this. Yet it's the foot in the door. So they're very, very important. Now, if you're a larger, when I've worked with larger organizations, a small sale might be $20 million. It's a throwaway sale when you're selling an $800 million product or a $700 million product. They're still just as critical, yeah? Okay, although even a $20 million sale doesn't happen in 3 meetings. So is CRM more useful for key accounts rather than a fragmented customer base? No, it's as important for both, yeah? In fact, more important for fragmented accounts because you've got to, if you have fragmented accounts and you have that scattered model, and you don't have a CRM system managing it, you have no ability to forecast accurately. I mean, none, yeah, right? The more fragmented your customer base, the more important CRM is for your business, in my opinion. And the more important that it's set up the right way to manage that fragmented customer base and give you the insights. And the idea of a CRM is we want to help our salespeople manage a customer base like that. So there needs to be a system and a strategy around that. That gets managed through CRM. If you don't do it through CRM, it's random. You know? And often a fragmented customer base isn't a fragmented customer base. Actually, often it's just the fact that the data is not there, not accurate. So you have your byproduct is a fragmented customer base because you don't have the information in the right place, managed the right way. So any questions, just pop them in the chat there, yeah? So again, I agree, small deals are easier to close, turnarounds faster, it's good for cash flow. Okay, so let's step into a normal sales cycle. Or I call it a normal. It might be a software sale, you know, 50,000 recurring revenue, or you know, $100,000 piece of machinery. I mean, we can call it whatever we like. In that realms of 10,000 up to 200,000. It's not a difficult decision-making process. Pretty simple. Not too many stakeholders in the business that you're talking to. So it starts again with an opportunity. It's unqualified. It could be a courtesy visit. It could be ideally is a first meeting. Normally in a sales cycle like this, you'd be stepping into an NDA. If you want to get more information, you would then step into a simple discovery. It might be 2 or 3 meetings that sit around the discovery. The idea is that you've got that commercial qualification, you've got the stakeholder engagement, you've got the information from the client that allows you to then step into collaboration. It then allows you to submit a proposal. Now, the collaboration piece here might be a demo. It might be sitting down and having a sort of semi-negotiation as you navigate into that first proposal. You'll notice the demo is not second. The number one mistake that's made in software sales is the demo is done way too early. A demo should be pretty much the last piece before proposal. And then we step into a new client and onboarding and payment. So you've got a very nice simple structure here. Again, if you have a sales cycle that has nobody in stage 4 or nobody in stage 3, or the accuracy of what's in stage 3 or stage 4 isn't correct, and the forecasting of that is inaccurate, usually there's two parts. That one is the information is incorrect, the management of the salespeople is incorrect. The second part is you now have inaccurate data, and as Jeremy is going to share with you later, which is from a CFO's perspective, yeah, the impact to your business is staggering here, right? It does not allow you to run your business properly. So then we step in a complex sales cycle. A complex sales cycle for me is $1 million plus, or a highly complex tailoring of a product with multiple stakeholders. I mean, you know, and these vary from, you know, 6 or 7 meetings right through to 30 meetings, a 3-year, anything from 6 months to a 3-year process as well. Again, they all start with this unqualified opportunity, which is a courtesy visit or a first meeting that develops a relationship. Generally, when you're stepping into a complex sales cycle, they're expensive to run them. So you have a light discovery, which is that commercial qualification, go or no go decisions made here, which often doesn't happen the right way. Often go no decision gets made stage 4, but it shouldn't be made a lot earlier. In leaving it late, it ends up costing the business a lot of money. You then step into deep technical discovery. Now, this technical discovery sits around engaging with the key stakeholders within the business. And it's a really, really critical piece that often gets done at the wrong time. Yeah? If you do it at the wrong time, you don't get access to the right people in the business, or you don't do it with enough people. Again, you're not getting access to the right people. You would then step into collaboration, qualification, demo, preview, a variety of other things that sit here. You would then move into that first proposal. You then step into negotiation post first proposal, and then you would step into new client onboarding. And when it's a complex sale, even when it's signed, it's not actually a sale until actually the revenue has been transferred. So each of these parts are broken very clearly. It should be broken and very clearly delineated with very clear gates that don't allow a part of a sales process to be in here or move forward or move back without a qualification that sits around it. And this should be intuitive. I mean, it's not a difficult thing to do, but it should be intuitive and it should be accurate, and it is relatively easy to do. You know? So for us, there's metrics sit around it. You know? Okay, so you've got a set of numbers that sit around this process that can allow you to strategically work out what your business is, what your salespeople need to be doing, and the accuracy of your pipeline. So what we're going to do now is we're just going to have a little bit of fun. And we're going to do some backwards planning. So let me just do a quick screen share here. Annika, can you share that Google Sheet? Have you done that? Yeah, you've done it there. Yeah. Annika's shared the Google Sheet with everyone. Let me just get this out here. So you can see here on the right. So, well, actually, let's look at the bottom. First of all, we've got table 1, table 2. So base that on the rooms, okay? So room 1, room 2, room 3. So whichever room you're in, I want you to open the sheet that correlates with that, please. So that's the first task. One person will download this. So if everybody could download this document, well, don't download it, but if you log into it, you log into the link, you have access to it. Don't edit someone else's room that's not yours. If you want to play with it, the last 2 are freebies and you can have a play with it, or you can have a play with it afterwards as well. I want you to look at this down here. One is a simple inside sales process. Look, there's 3 stages. The second one is a normal sales process. And the table 4 is a complex sales process. So I want you to think in terms of revenue. So, I mean, this was done before. Let me just quickly delete this. So what we want to do is when you have a complex sale, you start with the target volume of sales. So a complex sale could be $1 billion a year. It could be 5 billion a year. It could be $500 million a year, right? But what's the average sales size? That will then tell you the number of sales that you need to close in a year to hit your numbers, yeah? So that's your first metric. We then go, how many proposals does it take to get 1 sale? How many collaboration demo meetings does it take to get 1 proposal? how many discovery meetings does it take to get one demo, and how many first meetings does it take to get to discovery, okay? So I want you to sit down and crunch the numbers there. And then finally, looking at the number of first meetings that need to be done to get one discovery, how many attempts to book one first meeting does it take to get one? Yeah. So is it 2, 3, 4, 5? What are the numbers that sit around that? And then I want you to work that out. I'm going to jump from room to room. We'll discuss it. Then we'll come back in. Don't download it into an Excel spreadsheet, okay? Work in this document, then I'll share this, and then each table will run through it. And hopefully we'll get some insight and challenge you on the numbers, or congratulate you on the numbers because it makes sense. Anybody got questions? Has everybody downloaded the document? Give me a thumbs up if you've downloaded it. I've never seen so many videos off here, right? Is everybody like having the dinner, yeah, and got the kids in the house, yeah? So we've got 4, 5, 6, thumbs up, good. Everybody else? Now, really, I'm going to be gentle because it's an AmCham event, but you should put your videos on, right? Because it's too easy to skive off if you don't have your videos on, yeah, right? So when you go in the breakout rooms, I want you all to switch your videos on, all to put your microphones on, and all to interact in these metrics. And then Jeremy and I are going to jump from room to room and give you insight. So Jeremy, if you start at the top and I'll start at 1, right? And that would be good, yeah? So
yeah, that'll be fine.
Awesome, right? Any questions before we go? Easy, right? You thought you were going to be doing boring spreadsheets. Now you're doing like pipeline analysis. That's like really cool, yeah? So, right, let me just go to these breakout rooms and get this working. Okay, ready? Here we go. So how did you all find that? Jeremy, how did you get on?
Yeah, most of them seem to be grasping the concept very quickly, Fraser. And of course, we had some groups where we found that, you know, we needed 54,000 meetings, right?
Yeah.
Hit our number.
Okay, how did you all get on? Feedback?
I think initial 4 to 5 minutes we'll try. We were figuring it out that, you know, how this is going to help us.
Yeah, absolutely.
So we could arrive on some conclusions there.
Yeah. This is not easy to do, right? So it's not so intuitive. And what it is it's basing a set of metrics around a sales cycle on ratios. So it's starting to get you to think about ratios in sales, which isn't something salespeople think about. So very few people know their ratios of what happens between stages, but you can only have a forecastable pipeline if you understand your ratios down to the decimal point, right? You can only understand at the point.
But I have a question here. I mean, the ratios will also vary. I mean, there cannot be any standard ratio. But it also depends on the kind of products you are selling. For example, if you're dealing with a customer and your products are in great demand, and you know there is like everybody really wants to take your product, and you're going to meet them, and it is getting converted. And sometimes when you have to push, and then the number of meetings can be more.
Yeah. See, so first of all, the ratios can be accurate. Okay. So they can be accurate, and they are often accurate if it's set up the right way and managed properly, okay? But secondly, you're correct. Ratios change based on products. They change based on the skill of the salesperson. They change based on, you know, the region, the current environment, the climate. But ultimately, you'll have baseline ratios there that you can run a business on and strategically know that I've got a problem with my ratios in this part of the world, or in this business unit, or this line of product. And ratios for small products might be very different to ratios for large products. I've got clients whose sales cycle is 4 years. You know? but there's still a ratio around that. For example, the average length of the sales cycle, yeah? Right? That we know what that is, yeah? I know down to the day what it is. Now, it doesn't mean that things don't fall outside it, but we can plan that. So let's just have a quick look at this, yeah? So this here, the target volume sales, we've got 20,000 sales with an average sales size of 10, right? So this is table number 1. You changed it, right? Anyway, tell me 5 proposals submitted to. So we target volume of sales 20,000, okay? To do 40,000 attempts to get a meeting doesn't make sense, right? So if we change this to...
I think this 5 is too high. Submitted proposal.
Well, that's exactly right. Well, yeah, see, if you've got a number, like say, let's just say it's a very small business, $20,000 you want to turn over a year, and the average sales size is $1,000 hypothetically, right? So they need to make 200 sales a year, okay? So for every 5 proposals, they make a sale, yeah, right? That means, and they have to in a year submit 1,000 proposals. So if you own the business, if you're in management, if your business doesn't submit 1,000 proposals, you've got a problem, right? On a monthly basis, they need to do 166 first meetings. What happens if they only do 80 first meetings this month?
They won't meet monthly target.
If in the average timeline of the sales cycle that it takes to from start to finish, at the end of that, they will have half the volume of sales coming in, yeah? Fact. It cannot be avoided, yeah? There's no, unless they win the lottery, but that's not what we're talking about here. We're running businesses, yeah? So let's take a look at, I will just randomly.
But in this, I have a question. Is this the ratio correct? I mean, this 2, 2, and 5 in table number 1, is this ratio correct?
No. No, it can't be correct. That's not a sustainable business model. Yeah, you couldn't run your business like that. Yeah.
Okay.
You couldn't afford to have someone. You couldn't afford to pay someone on that turnover to do 100 first meetings a month. Yeah. So you can look at this and say that's not sustainable. We need to close the business down, right? I'm sure Jeremy will tell you that. He's the CFO. Yeah? Okay.
But can they increase their average sales size?
They could, exactly. They can play with the numbers, and Jeremy's going to talk about that later. So this is where you play with the numbers. Yeah. So you start with a guesstimate, but when you're running your business unit, you should know what the ratios are. Yeah. Now, the problem comes if you don't have a clear methodology for assigning a pipeline prospect in the right stage within the sales cycle, and the salesperson's not interacting with the client the right way, or the team, or whoever's engaging. So let's look at a simple sales cycle here. Yeah. So we've got the normal process. Okay. So target revenue is 500. Is that 5 million? Yeah, 5 million. Okay. 120,000 there. Do you guys want to, in that table, at table 3, do you want to tell us what the basis of this was? You're really quiet tonight, yeah? That's because you're all sleeping, eating your dinner, you're right, and then you're doing all your emails ready for tomorrow, yeah? Who's in table 3?
I think we were thinking that this is like the machine sales, you know,
okay.
Cool. Selling about, you know, per machine about $60,000 machines. So, you know, you put close 2 to 3 or one in between 1 to 5 machines per contract. Right?
Yeah.
So basically that's how you arrive. Right? And of course, then this goes back to the number of demos you do, the discovery and stuff, etc.
No, that's great. So it's a machine sale. So we know with a machine sale, you've got the cost to build, you've got the cost of material, yeah, right? So the margin in a machine might be 40% or 50%. I mean, whatever that number is. I mean, Jeremy will know better than I do. So we know, right? We've got a 5 million, we've got a 41 closed sales here, 3 collaboration meetings to get one closed sale, 2 discoveries to get one collaboration, 2 first meetings to get one discovery, and 3 attempts to book a meeting. So my sales rep needs to do 41 meetings, first meetings per month, or 10 first meetings a week, okay, to hit the number there of 5 million. You know? But at 5 million, if my profit on that is 2.5 million, right? Is it, if it's that much, yeah, okay, which is very unlikely for machinery, okay, can I afford to run a salesperson at that level? Where's the breakdown? Where's the problem with these numbers, yeah? Okay, so they're doable, but it's very, very marginal, yeah? And they're doable because the sales size is bigger. I would have 2 reps doing 5 meetings a week. Now, what is the average number of first meetings that a sales rep statistically does on a weekly basis? Does anybody know what the number? Put it in the chat. What do you think your salespeople do on a weekly basis with new clients? What do you reckon? Okay, good. Anybody else? So the number is about 1.2 per week. You go away, you take a look at it, you'll see that it ends up usually between 0.9 and 1.2 per week, virtually in every industry, apart from commoditized industries like banking, where they control the appointments because they have the client base there, okay? But where the rep has to get the lead, 1.2 per week. So then you sit and say, if it's 1.2 per week, I need to have about 7 to 8 reps to hit that number, yeah? So let's take a quick look at the complex sale, yeah? Table 5. Okay, so we've got 20 million, okay? Is that right, 20 million? Well, you guys, 2.5 sales a year, right? I want that, that's the job I want, yeah? Very nice, yeah? Okay, but let's play with this. 2.5 closed sales to get to 2 proposals to get a closed sale. I would suspect on a sale that size, it'd be a lot higher, yeah? You will not be 2.5 to get 1, yeah? Okay, collaboration might sit in that zone there, and the number of first and service meetings here would be profoundly higher to get a revenue stream at that levels, yeah? Okay. But if we look at it, in theory, we need to be doing 60 first meetings a year. That's 1.2 first meetings a week. 1 rep could do this comfortably, yeah? But then I would be asking the question, if 1 rep can hit these numbers, and this is the ratios, why do you not have 4 reps? And why are you not selling 80 million, over that period of time, you know? Or why doesn't my rep do 2 meetings a week instead of 1, you know? So what this is about is it's about ratios. It's about the number of the accuracy of the data and the ratio of the stages, you're right, and how the sales process works. Yeah? Right, so any questions? And then I'm gonna hand over to Jeremy, and he's gonna spend half an hour with you, giving you a CFO's perspective on this. Question?
Yeah, there's one question in the chat, Fraser, and it's questioning, is this assuming that it's all new business and nothing is repeat?
Yeah, it's a great question. 40 to 70% of your revenue should come from existing clients, okay? So, but even with existing clients, in stepping into a pipeline, you still go through the same process with them. It's just a little bit easier to sell to them. Now, it depends if the existing client is coming to you and saying, I need this, or you've initiated the conversation with the client and you're working with the client to build the RFP. It's still the same problem. Just because you're the incumbent doesn't mean you get the right to the sale, yeah? So engaging with a customer early is the secret, you're right, to increasing your ratios with your existing client base, yeah? And having that trusted relationship. So I think most businesses should be having 50 to 60% coming in. Yeah, Jeremy's going to go through that with you. So that's the idea. That's where we're leading with this. It's exactly right. And that my point sits around this fact that I work with companies building these models. I have not met one business that has a solid structure and accurate ability to forecast and a set of ratios that do this. Yeah, when we first meet them, it's not common. Most businesses have very low accuracy on the forecasting in the pipeline, but Jeremy's going to go through the benefits of that. So, right, I'm going to leave you to it. Jeremy's going to take over now. Thank you very much. I hope that helped. And the idea is to get you to think about things differently, but think about numbers, think about quantitative data, and now listen to Jeremy, because actually he's the expert. So thanks, Jeremy.
Thank you. And in fact, there's a great question coming in the chat room is about, can we use this tool for resource planning based on business size? And that's exactly what one of the things we're going to be talking about as we get into my section. So let me share my screen.
Fraser, just quickly, there was one more question. What are right ratios? Sorry.
Yeah, I'm not going to cover that just now. Maybe if we've got time at the end, yeah, right, we can do some Q&A. But thank you. It's a good question.
Okay, folks. So we've learned from Tim that obviously managing cash is important, and we're going to talk about how this CRM system can help you manage cash. We also learned that sales and gross margins are another lever you can pull to grow your business. And again, we're going to talk a little bit about how CRM can help that. And Fraser's talked to us about the power of backward planning by looking at the number of very initial contacts you have. If you can get your metrics right, you can improve your forecasting. So I'm going to talk about the CFO, because I have been a CFO for many years. I'm going to talk about what I call proactive sales analytics, because if I don't know, maybe your company, because we're really talking to one company here, maybe you already have CRM and it's working very well for you, but for most people, CRM is not effective. As Fraser said, there is a very high failure rate for CRM in customers. And I've worked for a company, I worked for an American multinational, and we had several attempts to put in CRM, and it really was not very effective in all reality. And one of the reasons was we looked at it as a sales tool for the sales team. And as I've worked with CRM, one of the things I've begun to understand is that, as Fraser said, it is a company-wide system and it should be used by the company. And in my opinion, I think that the CFO is one of the people who should have a deep involvement in the process. And so we're going to talk about that because one of the things you want to understand, CRM systems are generally not inexpensive. They're usually quite costly to implement, and you want to make sure you're going to get a return on your investment. So what can we do with CRM? And as Tim said at the start of the presentation, financial systems record history. Right? They tell you what has happened. It's a rear view mirror. You're looking back. The P&L is the performance of your company over a period of time. It's a month, a quarter, a year, but it just records the past performance of your business. The balance sheet is just a snapshot of the state of your business at a moment in time. So they're all rear view looking. CRM done properly can actually project forward, and because it can give you a projection of the future, you can use it to influence the future, and so you can use CRM to make the history of your organization. So let's look at the role of the CFO today and why I believe that CRM and the CFO do match up very closely. When I started work more years ago than I'd like to mention at the moment, the CFO was quite often called the chief accountant, and their role was very much that of, being the custodian of the company's accounts, making sure the statutory accounts were filed, the treasury functions were done properly, with maybe a little bit of management accounting thrown in, but really they were doing what we might call regular processing today, managing the account transactions. With the advent of computers and the fact that we can do so many routine tasks now automatically, the evolving nature of analytical tools that are available to us today, the CFO's role has changed significantly. And today, the CFO can be seen as a catalyst for the behaviors across the organization, that they drive activities to improve the strategic objectives of the company. They're a steward who protects and preserves the assets of the organization. And by this, I don't mean just preventing fraud, although obviously internal audit is part of the role. I'm not talking about fraud in that area, but also making sure that the company's assets are used to the best use that they can, and that they're optimized in their application, and avoiding waste. It's one of the very important things, and making sure that working capital is well managed avoids waste, and therefore that's part of the role of the CFO as a steward of the company's assets. There also should be a strategist. I do believe the CFO is ideally placed to set the company's strategies going forward. I always argue that the CEO is often not told bad news. No one wants to go and give the CEO bad news that something has gone wrong. But with the CFO, because he's accounting for everything, usually can spot these issues. And therefore, maybe the CFO has a slightly broader view of the company than even the CEO has. And to be quite candid, the CEO has other activities that he should be working on rather than delving into the weeds of the company. So I think the CFO should be seen as a strategist. And obviously, finally, he's an operator who interprets information to maximize return. And we're going to talk a little bit about how he can help the sales organization as we go through this process. But he's there because he is quite often acting as the COO as well as the CFO. So how can proactive sales analytics help the CFO adopt these 4 roles that he has? Obviously, it provides information, which the CFO needs to be a catalyst for the information. If you look at PSA, it can help identify waste. Sorry, we're getting a bit of feedback there. It can help identify waste, as I mentioned before, due to the data that's being duplicated, being put in twice. Another area that PSA can help in terms of making sure that we're delivering higher returns. In the sales process, there's quite often a handover from one salesperson to another. I worked for a long time in the construction industry. I worked for WR Grace, which then became Grace Construction Products. And we had a company that made chemicals that went into concrete structures. And if you're thinking about a big building, Taipei 101 as an example, when we're starting to sell to a building like that, we'd start by talking to the architect, and we'd start by trying to get them to specify our materials in their construction product. Once that had been done, it would then be put out to bid, and the contractors would start bidding for it, and we want to be using our products there. And we'd have 2 different sales forces. One was a specification sales force dealing with the architects, and then we'd have the contractor sales force dealing with the contractors. And there was a handover there. And sometimes that handover went very smoothly, sometimes it didn't. But by being able to track your sales processes, you can start seeing if there are breakdowns occurring. So I think that's important. PSA can really improve sales forecast accuracy. And I mentioned it earlier that one of the things that the CFO should be is a steward of the company's resources. And if you can improve your sales force accuracy, you can really drive many improvements within your organization. It identifies opportunities for improvement, allowing the CFO to become a better strategist because he can see the big picture, and quite often by being able to see the big picture, he can see where one change in one area, could it have unintended consequences down the road? So his ability to have that big picture, again, PSA can provide him the information he needs to drive things forward. And then finally, of course, it does allow him to be an operator. And in this case, what I'm talking about is supporting the sales organization. So what do you need to do to be able to deliver proactive sales analysis or analytics? What's the key to driving this going forward? Well, first of all, you need to be able to interpret the data. And one of the keys to being proactive is not just to measure the data at the outset, at the end part, you know, sales per sales rep, sales per month, sales per week, sales by customer. These are all lagging indicators. Once again, they're telling you what has happened. And to be proactive, you need to be looking at what will happen. So I like leading indicators, that KPIs that are going to tell you and help you predict what's going to happen. And to do that, you need to be looking at each stage of the business. For instance, if we look at the target acquisition list, the very first stage in the business, we know how many targets we need to identify. Are we identifying the right number of targets? Are we on target to meet our target? And so that's one of the things we need to do. And one of the things I also like to do is look at the time spent in each stage, because the faster you can move through this process, the faster you can get to your end goal, which is a sale and MRR, monthly recurring revenue, which is what you want to get to. And if you can move through this process faster by tracking each stage and the time in each stage, you can drive that sales process to a conclusion much faster. And that's key. You can also out of this get pricing information. You know, if you have, particularly if the sales rep has margin goals, he will be wanting to know what's the best price you can get. And by analyzing your metrics and looking at these stages and these numbers, you can help him drive pricing information. You know, Fraser described that sales, it's a cycle. And that supports the work, you know, the sales. It's critical to measure that in each step. And by doing that, as Fraser mentioned, you can get these metrics to be accurate. And you can only do that by measuring and continually looking back and understanding the metrics. And by tracking these things through, you can drive those metrics so that you get a much better picture of how many first meetings you really need to drive that sale at the end. So that's a very important part. And once you have confidence in these metrics, the more they can be used to forecast. And the more confident you have in your forecast, the more you can use it to plan. Just imagine the advantage of being able to predict a surge of sales 3-6 months down the road because your early metrics are telling you that's what's going to happen. Think how you can manage your business much more effectively if you can do that. It can also be used as a sales performance tool. Fraser mentioned that, you know, the performance by sales representatives will vary. They won't all deliver the same performance. So you can use this to identify your best performers, and then you can use that information to learn what do they do? Why are they able to drive sales faster through the pipeline than the average person? And you can learn from them. You do that not just by talking to them, but by observing what they do and see what they do that's different from other people. And thus you can drive improved performance throughout your sales organization. It can also be very helpful, and this is always a difficult subject, in terms of poor performance. To be candid, many of us take too long in making that termination decision to our employees. We do tend to drag it out. We tend to give them the benefit of the doubt. We give them one more chance, etc. But think about the fact that if you have a sales representative, particularly if you say you have a long sales cycle, like 6-8 months, and you can see that very early on that this sales representative that you hired is not hitting his early metrics, you can understand that he's not going to hit his sales numbers down the road, and you can take earlier action. So this kind of thing can be used as a performance tool and helping you to continually improving the quality of your sales organization. So Fraser mentioned that quite often CRM doesn't work. And one of the reasons, in my opinion, that CRM fails in an organization is because the salespeople are putting in data and they're getting nothing back. And that's something you must avoid as the CFO or whoever's managing this, but you've got to give the sales team something in return for the work they've done. You know, as they say, tracking data is not enough. Sales data needs analysis and interpretation. So if you think about it, you've got data, you organize it, you get information, analyze it and interpret it, and you get a powerful tool to driving your business, to improving your business performance. You can drive your business performance in many ways. Obviously, as I mentioned, going through the sales pipeline faster can increase revenue. Making sure you have the resources available to make sure you can hit those revenue numbers, that you're not asking too much of your sales organization can help. Pricing information can help you drive your gross margins. Again, are some sales reps getting better prices than others? And if so, why? How can you use that to improve your gross margin? Working capital can really benefit from this process going forward. If you can accurately predict your sales 3-6 months down the road, think how much better you can manage your inventory. You don't have to have a huge buffer inventory available. You can reduce that buffer. You can then work closely with your suppliers so that they can get closer to delivering products closer to the time you need them, and that will drive down your inventories. You can also go and talk to your suppliers because you have an accurate sales forecast. You know what you're going to be asking from your suppliers, and you can talk to them about price reductions based on the fact that you're a great customer. You can give them advance notices, and you want either a reduction in price or you want better sales terms. So another way which you can improve your working capital. And you can probably also improve your accounts receivable, because by understanding what's going on, you're going to be able to avoid mistakes. You're going to avoid stock outs and delays and mistakes and errors, which enable the customer to give them an excuse to delay payment. So a lot of ways you can use this to improve your working capital. And of course, all of those elements help you develop and improve your profitability. Spreadsheets, I'm a CFO, I'm very comfortable looking at spreadsheets, although having said that, if someone sells me a 50-column spreadsheet, 500 rows long, I also get turned out. But many people are much happier working with pictorials and dashboards, and I do really recommend that you put a dashboard together. Remember, if you can provide people with data that they didn't know before, useful data that they didn't know, they will become engaged. They will become proactive in information because you've shown them something they don't know, something useful that they don't know. So think about developing dashboards for your sales organization. Also very good for the senior management. Gives you a very quick picture of your business. And because these are leading KPIs, it gives you a forecast for what's going to happen. If you can, make it an interactive dashboard so that people can cut and slice and data in different ways, because that will make them use the dashboard more effectively than they have in the past, and that will help them significantly. So, I mean, just to wrap up my section, why does CRM fail? In my perspective, you've heard Fraser's perspective. From a CFO's perspective, I think it can create a feel-good factor. Oh, we've generated all these meetings. Well, that's great, but if they're not moving through that pipeline fast enough, generating those meetings isn't going to help. You need to make sure that people enter the data consistently, and you don't end up with multiple versions of the truth. So it's the old garbage in, garbage out. Make sure that the system is entered properly. Sometimes there's a failure to act on good data. I said large spreadsheets turn anybody off. Pivot tables can cause dread in sales organization. I don't like pivot tables personally, but that does mean that sometimes the opportunities for maximizing revenues are missed. It needs to be adaptable. We all go through changes in our business environment. We've all gone through the COVID pandemic and what that meant to us. And so it's important that the CRM system can be adapted. Mentioned they don't maximize the potential. It's just not used properly. And I think my suggestion of proactive sales analytics will enable you to do that. And I believe that the CFO can help you in that area. So just wrapping up very quickly, how does a proactive sales help from a company perspective? Talked about better working capital management, lower inventories due to reduced buffer stocks and improved order scheduling, improved accounts receivable due to faster invoicing and fewer errors, better supplier relationships, which can lead to better terms and pricing. Enhanced production efficiency. I ran the operations for an American multinational across Asia, and these last minute changes, these urgent orders, these pop-up demands that haven't been forecast can play havoc with your production efficiency. And if you have better forecasts, the better you can schedule and the more efficient your production processes can be. Also, if you know what's going to happen, you can avoid write-offs due to obsolete or unused inventory. If you know that a certain range of products, the sales are beginning to decline, and you can see that down the road, 3 months from now, 6 months from now, maybe those sales are going to be lower, you can start planning your inventories, making sure you don't end up with obsolete stock or unused inventory. Because you can reduce your stock outs, because you have better forecasting, you can improve your customer service. And improved customer service is, Fraser's talked about getting your foot in the door. If you have a satisfied customer and you're launching a new range of products, they're going to be much more interested in talking to you because you've gained their trust. So the fact that you can manage your inventories, avoid stock outs, is very important. And then finally, if you're a cyclical business, and many businesses are cyclical, you can plan in ahead for what's required. So that will pretty much wrap up my part of the presentation. I don't know if there have been any questions, Fraser, from that.
There have been a couple of questions.
Okay.
Again, they're asking, what do target, TAL, and MQL stand for? I'll answer. Do you want to answer that?
Yeah, you do it, Fraser. Yeah. Your terminology.
Your target account list, right? When we're selling, we should be engaging in a target marketplace. Yeah. It should be very specific about the accounts that we want to engage with and the people within the accounts. So the target, TAL, stands for target account list, and then MQL is marketing qualified lead, right? So it's a lead with a qualification level from marketing. And Punya had a good question. She was basically saying, still not clear on the right ratios. Can you please let us know standard ratios? Right. So she wants a better understanding of ratios. And then there was one question. I'll come to that.
I mean, I think you're referring back to the ratios to put into Fraser's spreadsheet, and if you start tracking the various stages using this by looking at each stage and analyzing each stage, you will begin to learn those ratios, right? So if you go, how many from your targets TALs go to your MQL, right? And that's the ratio that you'll be able to determine over time. And I can't tell you what the right ratio is for your industry or for any industry, but by tracking it and measuring it, you'll be able to hone in on that ratio required.
I agree, and you should, like Jeremy saying, what we're doing is a guesstimate. What we should be doing, though, is knowing what that is to the decimal point. Yeah, so that's the problem in business. People don't understand the ratios at all, and if they do, it's a guesstimate. Yeah? So another question, Jeremy, right? And what is an appropriate data point or size of KPI, and what example for getting it more accurate in the sales forecast?
Okay, well, obviously the data point or size of the KPI is going to depend on your organization, but you know, I put some examples in that slide. You know, number of targets achieved, conversion rates, targets to MQL. It's going to vary, but there are a lot of opportunities for that to do, and the KPIs, as I say, will vary by your organization. But at the end of the day, as we've been talking about, the objective really is to size your sales organization to the sales organization that you can afford, that's going to deliver the result that you want. And you can learn that by improving those ratios and driving things forward.
So we've got another question. So ratios differ between size and product industry type. How do we know what is the right size? I think you've answered that, but
yeah, I mean, but it's raising a valid point. There isn't a one size fits all. And if you're working in if your company works in very different industries, just going back to my days when I worked for WR Grace, we had a chemical additives company, we had a ready mix additives company, we had a fire protection company, and we had a waterproofing company. The ratios and tracking those would all need to be done separately. You may need to use multiple systems for your company, particularly a large company such as yours, where you have a broad range of products, and you know, the ratios in countries may be very, very different. You know, and again, because you know, you may be able to tolerate higher ratios, i.e. you need more first contacts to deliver the result if you have a relatively inexpensive sales force, right? If you know, and I'm just going to pick two countries at random, and please don't be done that. I'm going to pick Vietnam because my wife is Vietnamese, and that's a relatively low-cost country to operate in. But if you're in Australia, which is a very high-cost country, I've worked in Australia, the metrics that you might be driving may be very different, just because of the cost of the people and the performance you require to achieve the results based on that.
Yeah. So just in a following question from Punya, and I'm going to come back to yours, Natsumi, is often we modify these ratios to ask for more resources, and there is no defined standard.
Yeah, I mean, I think the point is that you know, by using this process, you get the accurate ratios, and by getting those accurate ratios, you can identify the resources you're going to be required. I mean, one of my clients at the moment, it's a cyclical industry. We know we're going to need more resources come July, right? Because we're doing our tracking of our sales. We know in July, August, September, we're going to need increase resources, and so we're already hiring those resources to have them in place when that surge comes. And again, so that if you can see that you're getting many more first meetings, because you know, suddenly your product is gaining traction in the marketplace, you can identify down the road that you may need more resources. So yeah, I mean, I wouldn't modify the ratios. I would use the accurate ratios to get the right level of resources that you require to achieve your objectives.
Shan had a point. So for global organizations that operate across multiple countries, even if it is the same organizations, ratios would differ depending on country. Can I just add a bit in here, though? We have to be very, very careful. Often I hear that, yeah, in my country it's different, and often it's not. Right? Actually, it's just that they're not so effective. Right? The people are not so effective in the structure. So again, you have to come back to the basis of your numbers and the accuracy of the data. So there's a constant pushing on that accuracy of data and the ability of your teams to take that sales process the right way that creates accurate data. You know? So, and that comes back to the managers. The responsibility 100% sits with management and the management of their teams. Yeah, and think about it like this: if you were managing a marketing campaign and you were spending 10 million in a marketing campaign, and on Monday morning you would do a post at 9 o'clock, and the post went out at 1 o'clock, that wouldn't be acceptable. The post has to go at 9 o'clock, and you know, this is the level of detail that you need to have, and understanding sales should not be sitting in a space where no one knows what's actually going on. Yeah. So, yeah, but it could be different. Yeah. So I just want to come back to Natsumi's question. How can we collect benchmark? It was a good question. Benchmark ratios from competitors.
Yeah, I mean that is a challenge to do, and be careful talking to your sales team, because they will generally overestimate the ability of your competitors. You know, I've never worked for a company yet, and I've talked to many sales managers around the world. I've never met for a company yet where the salespeople aren't telling me that my competition have better products than I have at lower price. I continually get that feedback. It can't be true, right? Otherwise I wouldn't be selling anything. It cannot be true. So, I mean, maybe there's some industry data you can track back on. Maybe there's an association, but it is difficult to understand, to accurately identify. But that if you look carefully at their sales processes, you might be able to get a better feel. But
I don't think you can find that information out, because I don't think most companies know their data. Yeah, so
that would be your point. Yes, right.
I think you have to build an accurate data set yourself and focus on you. Yeah. And like Jeremy said there, I get that all the time. You know, people that have the best product and the most expensive product complain about their competitors that have a cheaper product that's not so good. Yeah, right. You know, so everybody complains about their space. The reality is, what do the numbers actually say? Because that's an emotional conversation. I want to know what are the ratios. If someone says, because of COVID, our business is down, for me, I would go, right, tell me about the numbers. Where have the numbers broken down? How many first meetings? How many times did someone, you know, what is actually happening? And is it us that's the problem, or is it an environmental or a current issue that's creating the challenge? And I think there's a very interesting example in that. If you look at Dell, okay, the computers, you know, and software, right? When we stepped into COVID, they were panicking. Yeah, they were very nervous about what was going to happen with COVID. And actually, they're completely sold out in monitors for the next 6 months. So actually, we should be looking at the numbers and what's going on, not in what we emotionally are worrying about. And you know, that's how we should manage our businesses, in my opinion. Right, any more questions? Right, everyone ready to go home?
I think they're all at home already, Chris.
Yeah, that's true. All right, you can go and have your dinner. Yeah, I just put my curry in the oven. So,
good man.
Exactly. Yeah. I don't know. Let me give my perspective, and then you wrap up, Jeremy. All right. You know, if that's
well,
okay.
AmCham should wrap up at the end.
Yeah. Just let's finish it. So Jeremy and I, we both are of the belief, right, that you need to know your metrics. And the idea of this session today is to challenge you as a manager and get you to think about the importance of numbers, and not just the numbers that traditionally sit with an accountant, but actually as a manager you're responsible for more than that. And so hopefully you've walked away with getting it from a sales perspective, getting it from a spreadsheet, getting it from Jeremy's insight as a CFO. Your thoughts, Jeremy?
Yeah, let me just build on that. I mean, one of the messages I was trying to communicate is that there are systems such as CRM, and it's only one, where if you can use it to interpret data and manage it, you can drive business efficiency. CRM is one. I don't know what processes you might use for your research and development, but I would say as a CFO, you should be really on top of the stage gates through the R&D process or the product development process. Because again, if you can get that product to market faster and get those sales coming in, you can improve your business profitability. So tracking metrics on computer systems that are being used by your company can really drive performance. And I think one of the mistakes that companies make, and I'm not saying your company makes it, one of the mistakes they make is they think the CRM is the sales system. The product development system is the product development system, and it drives product development. Whereas if you look at it on a broader context, there is the ability to use that data to drive your business forward faster and more profitably.
Okay.
That's my sum up.
Yeah, excellent. AmCham, over to you.
Thank you so much, Tim, Jeremy, Fraser, Annika. Really appreciate you breaking down such a complicated topic. I mean, obviously, this is there's so much breadth to this topic. There's a lot to cover, but I thought you did an excellent job. Thank you so much for engaging with our members. Thank you to our NextGen cohort for hanging in there. I know 2 hours of just numbers is really difficult after a full day of work, but really appreciate you being really engaging. So without further ado, I mean, I will leave you to get some rest, and I look forward to seeing you again in a couple of weeks for our next session.
Okay.
Thank you.
Thank you.